In the world of high finance, money rarely moves in small amounts. But even by elite standards, the scale of financial transfers linked to Jeffrey Epstein was extraordinary. Investigators and financial reports later revealed thousands of wire transfers totaling well over $1 billion moving through accounts connected to his network. For most people, a bank transfer is a simple action. You send money, it arrives, and that's the end of the story. But in the financial world Epstein operated in, a transfer is never just a transfer. It's a signal. It reveals relationships, structures, power flows, and sometimes secrets about how the global financial system really works. To understand why these transfers mattered, you first have to understand how elite wealth actually moves. Billionaires rarely hold most of their money as cash. Their wealth exists in layers: companies, trusts, investments, private funds, offshore vehicles, and corporate holdings. When money moves at that level, it's not simply being spent, it's being repositioned. Epstein's role in this system wasn't just to advise clients. He often sat at the center of these repositioning processes, coordinating transfers between banks, accounts, and investment structures. That position made him less like a traditional advisor and more like a financial traffic controller. Reports later indicated that thousands of wire transfers linked to Epstein's network passed through major global banks. Some estimates suggested that transfers across several institutions totaled well into the billions. Numbers like that don't happen by accident. They indicate repeated, large-scale movements of capital: investment placements, asset reshuffling, consulting payments, trust funding, or cross-border transfers between entities. Each wire tells part of a story, and together they form a map of influence. Because when money moves in large quantities, it tends to move between powerful people and institutions. One of the key things about high-value transfers is that they create financial footprints. Banks track them, compliance departments review them, and regulators may eventually examine them. But the system isn't designed to stop large transfers, it's designed to report them. As long as the paperwork matches the transaction, the money usually moves. Epstein understood this well. Instead of trying to avoid the system, he worked inside it, using legitimate banking channels to move huge sums while embedding those transfers inside complex financial structures. This is how modern wealth often operates, not hidden, but layered. Another important element in Epstein's financial story is the number of institutions involved. Major banks don't typically allow massive flows of capital without ongoing relationships. Transfers at this scale imply long-term engagement between wealth managers and banking systems. In elite finance, banks compete to maintain relationships with clients who move hundreds of millions. These clients generate fees, deposits, investment activity, and prestige. When someone like Epstein manages access to such clients, banks often view that relationship as strategically valuable. That dynamic can make the flow of money smoother than outsiders expect. But beyond the mechanics, there's a deeper financial principle at play. Money movement equals influence. Whoever controls the transfer process often holds more power than the person who owns the funds. This is especially true when wealth is distributed across multiple jurisdictions. A billionaire might have assets in New York, investments in London, trusts in offshore territories, and private deals spread across continents. Coordinating that network requires someone who understands both the technical and relational sides of finance. Epstein positioned himself as exactly that kind of intermediary. Financial transfers also revealed timing, and timing in finance is everything. Large movements of capital often occur before acquisitions, during restructurings, or ahead of market shifts. They can signal entry into new investments or exits from risky positions. When analysts later examined transfer patterns linked to Epstein's network, they saw not random flows but repeated high-value activity over many years. That consistency suggests he wasn't just moving money occasionally, he was operating an ongoing financial engine that required constant repositioning of capital. Another aspect often overlooked is how transfers can pass through multiple layers before reaching their final destination. Funds may move from a client's account into a holding company, then into an investment vehicle, then into a partnership or trust. Each step may serve a financial purpose: tax efficiency, legal protection, confidentiality, or operational convenience. Epstein's financial structures allowed him to coordinate these layered movements. From a technical standpoint, each transfer could be legitimate, but from a systemic perspective, the network itself became highly complex, making it harder to see the full picture at any single moment. This complexity is not unique to Epstein. In fact, it's a defining feature of modern global finance. The larger the fortune, the more fragmented its structure tends to become. Fragmentation reduces risk by ensuring that no single lawsuit, tax change, or market event can affect everything at once. Epstein's involvement in coordinating these flows meant he wasn't just advising clients on investments, he was helping maintain the architecture that protected their wealth. And the more money moved through that architecture, the more central he became to it. Transfers also reflect trust. Sending millions or billions through someone's coordinated network requires confidence that the system will function correctly. In traditional finance, that trust is placed in institutions. In elite wealth circles, it's often placed in individuals. Epstein built his reputation on being the person who could move money quietly and efficiently across structures. Whether clients relied on him for technical skill, personal relationships, or simply discretion, the result was the same. He became embedded in the circulation of enormous financial flows. There's also a psychological dimension to large transfers. For ordinary investors, moving money can feel risky or final. For ultra-wealthy clients, movement is normal. Their financial world is dynamic, not static. Assets shift between vehicles, opportunities appear and disappear, and structures evolve over time. Epstein's system allowed that movement to happen continuously. Instead of wealth sitting still, it remained in motion, adjusting to tax strategies, investment opportunities, or long-term planning needs. This constant circulation reinforced his role as a permanent manager of financial transitions rather than a one-time advisor. When authorities later looked at these financial flows, they weren't just seeing numbers on a spreadsheet, they were seeing a network of relationships, banks interacting with wealth managers coordinating with clients, and funds moving across borders through layered structures. In modern finance, money trails often reveal more about influence than about wealth itself. The direction of movement can indicate alliances, dependencies, and strategic positioning. Epstein's transfer network suggested he operated at a level where he wasn't just handling money, he was helping shape how elite capital moved globally. It's important to note that large transfers alone don't automatically imply doing wrong. Billionaires regularly move huge sums for legitimate reasons: investments, acquisitions, philanthropy, or restructuring. What made Epstein's case unusual was the concentration of activity around a single intermediary. Instead of capital flowing through multiple independent managers, much of it appeared to pass through a network he coordinated. That concentration increased both his influence and the scrutiny that later followed. Ultimately, the story of Epstein's billion-dollar transfers highlights something fundamental about the global financial system. At the highest levels, wealth isn't defined by what sits in an account, it's defined by how easily it can move. Liquidity, flexibility, and reach are what allow fortunes to survive and grow across decades. Epstein understood that mobility is power. By positioning himself at the center of large-scale financial movement, he turned transfers into a source of influence rather than just a banking function. And that may be the most revealing lesson of all. In elite finance, the person who controls the flow of money often becomes more important than the person who owns the funds. Epstein built his position not simply by managing wealth, but by managing motion. Every transfer reinforced his role, every movement strengthened his network, and over time, those billions in motion created something more valuable than fees or commissions. They created financial gravity, pulling more relationships, more influence, and more power into his orbit.